Welcome everybody to the Ellsworth Advisors monthly update. I'm Kelly Keenan, this is Cameron Mealy. We're the managing directors for Ellsworth Advisors. Today we're going to review the economic numbers for the month of October, along with how the market performed and also how our portfolios did. Cameron, why don't you kick us off with an economic update?
Will do. Thank you, Kelly. Good morning, everybody. Biggest news that we've had to come out over the last couple of weeks was the third quarter advanced estimate from the Bureau of Economic Analysis for GDP. The consensus Wall Street expectation for third quarter GDP was a 2.8% annualized growth. Third quarter numbers came in at an actual number of 2%. This is obviously an extremely disappointing number. We had 6% annualized growth in the first quarter, 6.7% in the second quarter, now 2% in the third quarter. There are really kind of three main variables that are the focus of third quarter GDP. Number one, the Delta variant. Number two, the continued supply chain disruptions. And number three, the labor shortage. If we look forward to the Atlanta Fed's GDP Now forecast model for the fourth quarter, they're projecting currently that GDP will rebound to a 6% annual rate. So obviously, 6%, 6%, 2%, 6%. There was an issue in the third quarter, and that issue, likely is mostly the Delta variant. We saw a lot of shutdowns during the early part of the third quarter. The good news is, while we're in the midst of a 100-year global pandemic, it does seem like we're on the backside of it. It does seem like this is waning, hopefully with vaccinations, with treatment protocols, with understanding the virus better and taking better precautions. Eventually, in a couple of years, hopefully we're equating this to the flu. It is still a deadly virus, but it seems like we are getting past it.
Well, all the issues are really not so much because of the virus, but now these are all the side effects of all the steps taken to mitigate the virus is what we're dealing with right now. The resurgence in really July, August kind of slowed things down, that's for sure.
And so let's take a look at a couple of numbers. So this is according to usafacts.org, which is an independent research organization. Delta variant in COVID in general seems to be waning. According to USA Facts, at least 220 million Americans, or 60% of the population, have received at least one dose, and 192 million people, or 58% of the population, have been fully vaccinated. So 67% of the population already received one vaccination, 58% already fully vaccinated. We know now that more at-risk people are starting to see booster shots. Additional good news is we now have Pfizer-approved vaccine for children ages 5 to 11. That actually happened today. So it certainly seems like we can continue to see the U.S. getting back to work. These same trends are happening throughout the world. I wish vaccine rates were faster, I wish uptake was faster, but certainly every day more and more citizens of the United States are getting vaccinated, which should help get this issue under control. When we look at the supply chain, we're seeing kind of the same issues. Chip shortage, cargo container shortage, bottlenecks at the port. Unfortunately, it looks like a lot of these issues are not going to be cleared up until what analysts are saying mid-2022 to late 2022. So supply chain disruptions, that's going to lead to empty shelves. That's going to lead to rising prices. The other issue we're still seeing, labor shortages. We've quoted this number several times. We're still using the same number from August from the Bureau of Labor Statistics because we haven't gotten an update yet. But as of August, there were still 10.4 million unfilled jobs in the U.S.
That's what we're facing, and it's not going to go away in the next couple months. It's going to be a while. In the big picture, everything points to more inflation. How robust will it get is hard to say. Will we see late 70s, early 80s style inflation? It's once again, it's hard to say. You're starting to feel it at the grocery store, at the gas pumps. The other side of it, though, is there's liquidity out there from the stimulus that was provided by the government throughout COVID, and there's jobs, so obviously people are holding off to start working again.
Well, and that's why we're seeing a couple of other interesting dynamics that we have at play right now. We've got a Fed meeting happening today and tomorrow. The Fed is expected to announce their tapering program, their bond buying. We expect that to go down. That will keep, that'll stop with the artificially low interest rates. We should see interest rates rising. We also have, obviously, a very, very heated governor's race in Virginia, and that race is too close to call as of right now. Obviously, if that election goes one way or the other, it can bolster Joe Biden's presidency and the programs he's trying to push through. It can also be a detriment. So that Virginia governor's race is going to have kind of far-reaching implications over the short term for an infrastructure package, for a social programming package. If this infrastructure doesn't pass, if the social programming of $1 trillion doesn't pass, hopefully you stop seeing, there's the good and the bad. You see money spent on infrastructure, which is key. A lot of the U.S. infrastructure dates back to the early 1900s. But again, you look at social programs and money being spent, it is a disincentive to work. We have unfilled jobs. So this Virginia governor's race, it's going to have near-term implications in terms of the infrastructure program, in terms of the social program, but also is this going to be a harbinger for the main elections of 2022 and 2024. So I think today is election day. Obviously, this video won't be published for a few days after, but today really is going to have a lot of far-reaching implications for policy going forward.
Right, and with some of the stuff on the table with the infrastructure bill and the tax side of that bill, one thing I would note is that some of the proposals that were thrown out there tax-wise that were really looking pretty draconian, a lot of this stuff has been watered down substantially, and really at this point, most of the tax changes, they're minor. It's not going to really be earth-shattering for people in general. Even at the high end with the surcharges on income tax, in the grand scheme of things, not really that great. Nothing compared to what was being thrown out there early on.
And nothing like what we see in a lot of European countries.
Right.
So we're still going to have one of the more tax-efficient structures in the developed world.
Which is, I think, positive for the markets, positive for earnings, positive for the economic outlook in the short term. The reality is we're coming out of this long slog. It's how well they can contain inflation. Obviously, the Fed tapering is going to help. Will they raise interest rates? That gets a little scary. That could be something that could upset the markets. Speaking of which, let's jump into some of the numbers for the month. Last month, I'm going to jump back to September. September was a pretty ugly month where the Dow was down 4.29%. The S&P was down 4.79%. That was September. That was the last call. And in the last call, I was like, well, we could see some more of that roughness or some of that instability, which we saw for about a week or so in October. Since then, it's been, basically
off to the races.
Off to the races. We knew there were more highs coming, and they came pretty darn quick after our last call. In October, the Dow was up 4.15%. S&P was up 5.64. Nasdaq up 6.79. Russell 2000, which is small caps, 3.23. The MSCI emerging markets up 1.08, still lagging a little bit. And then the developed world MSCI EFA up 2.37. So a little bit of that move back to the kind of the big tech trade.
Yep.
We definitely saw that, and that's reflected in the higher NASDAQ, higher S&P 500. Year to date, this is through the end of the month, the Dow was sitting at up 17.03%. S&P up over 22.61, which even at the end of the month was, I believe, an all-time, was a high watermark for the year. NASDAQ has caught up a lot, up 20.25. The Russell, 16.32. Once again, emerging markets still negative, down 2.05%. Developed world up only 8.75. So big rebound in October. I'll go out on a limb and say there's probably some more highs between now and the end of the year. Obviously, there can always be a correction, but for the most part, I think the wind's at our back, at least in the short term.
Well, and the U.S. continues to be really the only place you can invest and get a real return on equities.
Right, and part of it is once again we're kind of the furthest ahead in recovery phase, or where we're at in the the whole COVID timeline, if you want to call it that. Portfolio-wise, our growth with income portfolio. Good month last month, up 3.5%. Year to date, we're up about 12%. the reality there is we're only about 55% in stock. So, we're really, I think, hanging in there pretty well. Big gainers, NVIDIA up 23.42% for the month. Nike, big pop, up 15.2%. Nucor up 13, Digital Realty up 9.25. Our laggards in October, Starbucks down 4.93. Oh, wait a second. No, I'm sorry. Starbucks was down 3.84. Microchip Technology down 3.5. Year to date, NVIDIA still leading the charge, up 96%. Nucor. We're up 34% since we bought it in May, so nice gain there. CVS up 34%. Lennar, the home builder, they're up 32.4. Cisco Systems up 28. Big laggards, once again, our emerging markets position year to date down 7.29%. Disney is still struggling, down 6.68, and gold, one of our, a piece of our commodity exposure, down 6.6. Dividend yield portfolio, really, great month here, up 6.5%. Year to date, dividend yield up 23%, so outperforming.
Not what you would expect.
No, outperforming the markets. That's good. Once again, in October, Blackstone, gift that keeps on giving, up 20% for the month. Year to date, Blackstone, we're up 121%. That doesn't suck. UPS for the month was up 17%. Merck for the month was up 17% also. Our laggards in October, we saw Cisco was up big in our growth with income. Intel actually down 8% for the month. LyondellBasell, chemical company down 1.1. British American Tobacco down 1%. Year to date, Prudential's up 46%, Eaton's up 39%, Waste Management up 38%. Year to date, really two losers, Verizon down 5.7 and British American Tobacco down 1.15. So, dividend yield is definitely roaring right along. I think the actual dividend payout on that portfolio is around 3.5–4%. So that's, creating good income and some good growth. Price potential portfolio, good month here, up 7%. Nice pop there. Year to date, I think this is the first time this year where price potential has been our leader for the year, up 24%. Big gainers there. Union Pacific up 23%. We actually just exited that position in the last day or so, taking our gains and running. ICE up 20.06%. Once again, Merck, which we held in our dividend yield, up 17%. Microsoft up 17%, so it's good strength there. Our laggards, FleetCor down 5.3. Facebook, which is now called Meta, down 4.66. Still giving Facebook a little bit of rope. We've only been in it, less than a year in this portfolio. Amgen down 2.67. Year to date, our big gainers, S&P Global up 45%. Microsoft, which we just got into in May, up 35%. Chubb up 29%. And once again, our big laggards, Amgen down 8 and Lockheed Martin down 4.3. In our small cap portfolio, up 5% there. We've actually, we're now 21.5%. Small cap has kind of lagged, had a good first couple months, did nothing. Now we're starting to get a little pop there. Big gainers, Mantech up 25%, Focus Financial up 16, Colliers International up 12. All three of those were purchased in October, so those are all nice short-term gainers. Triumph Bank up 12. Big laggards, the Joint Corp down 15, Fabrimet down only 3, U.S. Physical Therapy down 2.9. Usually we have at least one that's down double digits. Pretty solid month in SMID, so we'll take that and run. Year to date, our big gainers, Artisan Partners up 165%, Triumph Bank up 131%, Atcor up 125%, Echo up 79%. So obviously we've had some big winners year to date. On the laggard side, year to date, that we're still holding, U.S. Physical Therapy, we're still down about 9%. Allied Motion down 0.87. So, in general, it was a great month for our portfolios. I'd say probably dividend yield better than expected. Nice surprise out of SMID. Price potential kind of doing what it should be doing. So in general, great month, good recovery month. Like I said, I still think we have some wind at our backs, sticking with our quality bias, which is working. I think it'll continue to work. But as always, we have to expect a little bit of volatility or expect some pullbacks. The big thing coming down the pipe is, keep an eye on the economic weakness. And, in the grand scheme of things, when we start to see more recessionary signs, I think that's when the market's going to be most susceptible to really a major repricing. Mm-hmm. At this point, we kind of have to, kind of ride with it, know what we're in, stick with quality. We should be in good shape from a big picture standpoint of, looking at equity exposure. I'll start to get concerned about equity exposure, like I said, when the economic numbers start to show, hey, we're really looking more at a recessionary type situation. And there's things that can drive that. It could be, the Fed gets too aggressive with raising interest rates. I'm going to go on a limb and say just the tapering, I don't think is going to, it could cause some ripples in the market, but I don't think it's going to be a big, long-lasting situation, just because I think there's enough money out there that will step in and, do the bond buying that the Fed's been doing. It'll take some competition away, which we should see a little bit higher rates, but I don't think they're not gonna spike. I don't see that happening anytime soon. At some point, they will start raising short-term rates, and that's when the game will probably change a little bit.
U.S. Treasuries are still the safe haven of safe havens in the global economy. So money is going to continue. If it's not the Fed, it's going to be outside money that's going to continue to flow into U.S. Treasuries, and that'll continue to hold interest rates low.
Yeah, unfortunately, they pay nothing. So, you hate to keep money in cash because of the inflation side, but then again, cash is really the only true safety area where you can find a safe haven. And in the short term, I don't think inflation really hurts cash. It's the longer term, sit on cash for a long time, that's where inflation is going to hurt you.
Absolutely.
Not much more to talk about.
Yeah.
There's a lot going on, but then again, it's kind of the same stuff that we continue to talk about every month. The media picks up on it a little bit late sometimes, makes a big deal of it, but nothing that's been happening short term in the media. It's all things that we know have been coming down the pipe. So I think we see a little bit more of the same, at least for the next month or so. And we'll see what the end of the year, the new year holds for us.
Yeah, we think we're positioned really well. We're very happy with our portfolios. We're getting ready to kind of roll into holiday season, so we hope you all have a great end of the year. If you have any questions, want to discuss your accounts, as always, please feel free to give us a call. Have a great day.
Thank you. Have a great week.